Hello guys, this is the Complete Trader and you're welcome. So today's video I will be showing you guys the role reversal strategy. Okay, so what are role reversals? Role reversal simply means a bullish key level turning into a bearish key level and vice versa. Okay, so you can have a bearish key level turning into a bullish key level. So what am I saying, guys? I'm talking about a key level, for instance, where we saw price bounce from to the upside, not broken through, becomes a level where price bounces from down to the downside. Okay, just like the picture you see in here. Okay, so this is an example of a row reversal. Like a level which was formerly support, okay, now becomes a level where price is hitting and is now used as resistance. Okay, so um, when we learn about support and resistance, the techniques and all of those things, we are taught that when support is broken, it becomes resistance. Like if you've heard about when the floor is broken, the floor turns ceiling, and when the ceiling is broken through, to the upside, then it turns floor. Those kind of analogies and all of those things. But if you've been trading the support resistance technique, you will discover that many times, and this is it, many times, most of the times, we don't see that really happening just as it is shown in the textbooks. Okay, so it is not happening just as neatly as is shown in the textbooks. So they are not really practical, all right, because most of those examples and concepts that have been passed on from those teachers, who teach about support and resistance, they are not really clear, right, on this. So which is why most of the times you will see people talking about, more confirmations like patterns and all of those things. And it's good for you to have multiple confirmations for your strategy. I'm not against that. So well, let me not just go into all of that. I'll just give you what I have for you today. Okay, so row reversals. I'll be giving you two types of row reversal strategy. Now I promised to give you this since for a long time now, and today I'm delivering on that promise, and I'm giving you a little bit much more than what I promised. I'm giving you two patterns, all right, for row reversals. So the first is in the form of support and resistance, and the second is in the form of supply and demand. Okay, and so let me just show you what it is now. Okay. Um, so you see this level now. This level was formerly support, broken through, now becomes our resistance, where price sells from. All right, so you see the massive sell, and you can see how precise, how the price hit the level, and the moment it hits the level, it drops. So when can you expect this kinds of price action? When can you expect a support, broken, turning resistance? When can you expect that? When can you expect role reversals in the marketplace? There are certain price actions that you need to see. All right, there are certain price actions that if they don't happen, right, if they don't take place in the marketplace, if they don't take place in price, you shouldn't be looking for your role reversals. At least you should not be looking for price to turn at the area of, you know at the former area of support. Okay, or if we are talking about price moving to the upside, you should not be looking for price to turn at the former area of resistance. Do you get the point? So what are the price actions that we look for? Number one, please pay attention, because there are rules surrounding this strategy. There are rules surrounding the concept that I'm giving you. So this is the first pattern for role reversal, okay, and this one is resistance turn support, or support turn resistance. So number one thing that we look for is the structure of the market. Okay, so we look for our role reversal pattern in the current market structure. All right, so we are not focusing on anything that has happened to the left. All right, so for instance, right now when you look here, this is a bearish market structure. We formerly had this shoot up in price, and we've seen where price broke that level. So that's a breaking market structure, and then price moved up attempting to make a high, but we had a failure, and then continues downwards. Now we are in a bearish market structure. All right, so when I talk about structures of the market, I'm talking about what is happening currently. So we're looking at the current market structure. We're not focusing on the former market structure. All right, so the former market structure in this case is going to be when price was coming up, so price was making higher highs and higher lows, bullish market structure coming up. We are not focusing on that. We're focusing on what is happening now. All right, so that's the first thing we look for. Now, the only time when we can look at what happened to the left, okay, what happened in the former market structure, is the last range of that market structure. All right, so for instance, now we have a bullish market structure. This last range, the low of this last range, is the only thing we can look for if we want to look for role reversals. Let's say, for instance, we have the second criteria, which I'll be talking about right now. Okay, I'll be talking about soon. So if you see that second criteria being met at the low of this last range of the former structure, then we can look to take a trade for the role reversal strategy. Okay, but mainly we're focusing on the current market structure. All right, so having said that, the second thing that we look for is, and this is very, very key, I want you guys to pay close attention. So now you see, when price broke the level, how did price break the level? Are you seeing this candlestick I'm pointing? I'll zoom in, okay? You see, this is the candlestick that broke the level. You want to see this kind of solid break of that level. Okay, so you see a strong candle. This is an imbalanced candle. What is an imbalanced candle? An imbalanced candle is a candle that reveals strong selling or strong buying. It reveals a one-sided movement in the marketplace. Okay, so when you have that breaking the level, okay, you can expect to see a role reversal. Now, when this candlestick broke this level, okay, remember the 3-bar pattern we talked about? All right, so when this candle mainly broke that level, we never see price retrace back. Like in the case of the 3-bar pattern, we never see price retrace back to that point. Okay, because all of this was selling. Okay, and we need price to be balanced up. The marketplace has to be balanced up. There has to be buying coming back up to that level, and so we've not seen that happen. So you need to see this strong imbalanced candle breaking that level. So that's the second thing you look for. So the first thing is that we're looking at our current market structure, okay, and the second thing is that you're looking for an imbalanced candle breaking that level. So the reason why you look for the imbalanced candle is because the habit of the market is to always balance up the marketplace. So when you have imbalance, the market seeks to balance the market up. It seeks to balance the marketplace. So when you have selling, a one-sided movement in the marketplace, just selling, a time will come when the market should come back to demand into that sales, into those supplies. All right, so this is the first pattern for our role reversal or flip zone strategy. So you formerly had a buy zone turn to a sell zone. All right, so the two criteria again is current market structure is what we're focusing on, and the next thing is we are focusing on how price broke the level. We want to see an imbalanced candle break the level. Okay, so that is when we can anticipate the level becoming a flip zone. Okay, so now let me show you the second pattern. This is really amazing, guys. The second pattern, like I talked about, is around the concept of supply and demand. All right, so when you see notable demand on your chart, okay, when you see a notable demand level, okay, not being respected, right? When it is not being respected, there is something fishy. All right, so let me show you. I may not go into much details in here about that because it would take a lot of explanation, and I don't want to make the video super long. All right, maybe in subsequent video we will deal on that, but let me quickly show you what I'm talking about. All right, so now you see when price, can you see this level? When price sold down to this point here, we saw a very strong reversal in price, breaking this former high, this little high here, and breaking this next one. So this was a level of demand. There was a level of strong demand in the marketplace at that point, this price level. So we saw this is a very strong level of demand. So if you understand about anything about the supply and demand concept, you understand that when we draw a demand level, we are looking at the last down close candle before the strong up move. That is where your demand is hidden. Okay, so you can look, when you look at this, you totally consumed that level. Look at that. Also, we saw when price came in here, strong movement in price to the upside. This was indicating strong demand. And I want you to focus on another thing that happened. This move actually took out a former high. It took out one high, two highs. It took out a high, a notable point where there's going to be resting what? Liquidity. All right, so this indicates institutional presence, the presence of institutional traders. So what happened on top here was that they took out liquidity. So most of the time, what you see here is an engineered movement in price. So what is an engineered move in price? This is mainly a move that was initiated to deceive the traders. So mainly people are going to be thinking that this price is going long. All right, so they initiated this move actually to take the other side of the trade of traders who are deceived. So if you are a trader, for instance, and you're buying at the breakout of these highs, you're buying at the breakout of those highs, these institutional traders will take the other side of a trade and begin to sell because they need buy side liquidity to be able to establish sell side positions in the marketplace. So their original intention is to sell. But then how they do it is that they get other people to buy so that they can sell. I hope you understand me. Okay, so sorry. So that's the level. So when this level fails, what happened? This is an engineered move, like I said. It takes supplies and demand to move price. So for price to go up this way, there was demand at that level. Okay, strong demand at that level, which meant that anybody who entered for a buy here, all right, so this strong move was not initiated by a retail trader, it was initiated by an institutional trader, people who have deep pockets. So when this move was initiated, taking out these highs, where we have liquidity pools, so when this move was initiated, lots of orders came in here, buy orders, causing price to shoot up. So when price came down, we were expecting that price should react from here, but it doesn't. It just broke through it. So what is going to happen? This is a point where the institutional traders are going to be mitigating orders. Do you get the point? They are going to be mitigating orders. So if you are closing up a buy trade, that should be what? Sell. And so that is why you see price dropping. So a failed demand becomes supply. A failed demand level, this was a demand level, but it failed to hold, becomes supply. Now, it was not just a demand level, guys. It's a demand level that took out liquidity. All right, so you see the criteria of this one is that it's a demand level or supply level that took out liquidity, but then fails to hold price when price returns to its origin. All right, so let me point that out. This is a demand level, for instance. All right, and it took out liquidity. When it shoot up like this, it took out this former high. The resting above that is going to be buy side liquidity. Anybody who sold here as price was dropping, right, they're going to be putting their what there? They're going to put their stop loss above there, and that stop loss is a buy side liquidity. So when price went up above that, it triggers those stop loss. Okay, it triggered the stop losses. Now price drops down. So we see that this demand took out liquidity, and when price returns to the point of origin where we should be expecting reversal, you know, like a push up in price, where price supposed to react from this level to the upside again, but we didn't see that. So it becomes a failed level. So price comes back into it, and now we see the level becomes a flip zone. Okay, so this is the second type of the flip zone we talk about. All right, I hope you love it. It is very short and sweet. I should say that, short and straight to the point. Okay, and this is really powerful, guys. It is really powerful. I really gave you guys something really beautiful on this one, okay, like a New Year present. So you can go on your chart. All right, so seriously now, you can go on your chart and look out for these things. And if you don't understand what I said, please watch it and listen again. Listen very carefully. So what I said in this video is really powerful, can be used as a strategy. All right, so some of you have been asking me, Complete Trader, what is your key level? What are the key levels that you look for? All right, so I've received lots of messages on, you know, Telegram, people asking me what kind of levels or key levels I look for. These are the key levels I look for. Now, these are not the only ones, okay? You know, for you to be able to spot these, you know, all the time on your chart, and it will take some level of, you know, consistency in looking at your chart and finding these things out. But it's doable. Okay, so go through your charts and find and learn about these things. Go through your chart, find these things out, mark them out, okay, and let your eyes get used to it. All right, till next time, guys, love you, cheers, and God bless you all.